Your market news now. The Fed held interest rates steady for a third straight meeting and gave its clearest signal yet that its aggressive tightening campaign is finished. Chair Jerome Powell indicated that policymakers are now turning their focus to when to cut borrowing costs as inflation continues to slow. Meanwhile, PGM and chrome miner Teresa posted a 31% decline in annual profit. This was mainly due to a drop in platinum group metal output and prices. Teresa said strong demand from chrome from China, as well as firmer prices underpinned by growth in the Chinese domestic ferrochrome and stainless steel industries helped partly offset the impact of the PGM price decline. To give us a little bit more perspective on the markets, we are joined by Zwelakhe Mnguni, who is the Chief Investment Officer at Benguela Global Fund Managers. Zwelakhe, thank you so much for your time. Your thoughts on that Fed meeting and what you got out of those dot plots?
Yeah, look, I think the meeting was probably in line with what we expected. I think we expected them to just hold the rate steady. I think where there was a bit of a surprise was that they themselves are now plotting for rate cuts in 2024. And they highlighted the fact that they believe that the demand is relatively more normal, but the supply side is only has normalized slowly after COVID. And they believe that it's close to being normal, the supply chains. So it looks like they are looking to engineer a soft landing on the economy, and I think that would be very, very positive for various asset classes, both bonds and equities. I think we saw today the market has been rallying quite strongly.
Speaking of that market reaction, I mean, you looked at the US two-year yield dropping about 30 basis points. You look at the Dow Jones yesterday closing at a record high. Was that market reaction justified, or is the market running a little bit ahead of itself?
I think it is justified. I mean, the fact that there is confirmation that rates are not going to go higher, I mean, unless there was an extreme incident, but it doesn't look like there's any. They confirming basically that rates are going to go lower. That means the hiking cycle is over. I think the market was right to react. I think we saw particularly the resources stocks or the economic sensitive stocks, the miners and the consumer discretionary, those type of stocks would basically benefit because that's where the pressure was. Most of the pressure of the high rates was in the market.
What's the number one question that your clients are asking you?
Probably more on the asset allocation. Do they go bonds versus equity? And I think until now, they probably skewed a little bit more into bonds relative to equities. So like a 60 bonds, 40 equities. And after today, I switched it back into, or at least after last night, I switched it back to 60 equities and 40 bonds. So there is a question also around whether investors keep their money in South Africa or offshore markets. And I believe that the offshore markets do have the diversity that we are lacking here in South Africa due to some of the challenges like electricity supply, freight rail challenges. But broadly speaking, I think I'd favor equities henceforth, and I'd be a lot more constructive about the global equities on top of that.
If you had to look at the winners for 2023, do you expect them to be winners into 2024 as well?
I would probably think that the winners for this year were like a mixed bag. I mean, the likes of Harmony, Textainer. I think if you look at the outlook, I mean, the gold sector probably struggle going forward if rates are not going to be hiked any further. And I think what you are going to see is that probably the PGMs, the diversified miners, those type of sectors will probably do better. So my simple answer is no. I would think that we're going to see a surge in the resources sector ahead of the actual delivery of earnings. So we'll see that earnings that we reported in the next 2 quarters, so Q1 2024, Q2 2024, they're likely to be below expectations, and then we'll see a ramp up. And I think in the US, we'll probably see also that we're going to have a much better ramp-up pace across other industries relative to the tech sector. So certainly I think there is going to be a shift in the winners versus the losers.
On that note then, some can describe this period as crystal ball season, where a lot of asset managers are trying to look into 2024. What's your base case for 2024?
I'm very bullish about markets, very bullish that with inflation coming down, bonds would also perform relatively well. I do think that one has to be very cautious about which stocks they select, which market they invest in. But broadly speaking, I'm very bullish financial assets going forward.
Is there a market trend that you expect to continue into 2024?
Yeah, I think the AI theme would probably be a major theme going forward. I think the decarbonization theme would probably continue, and both themes have got winners and losers. So on the AI, in the long run, what we'll see is that there'll be chip makers, the app developers will probably benefit, but on the other side, we'll also see some of the labor-intensive businesses also struggling. So administratively intensive businesses would struggle because they would lose some of that work would be taken by artificial intelligence. I think on the decarbonization, I think high polluters are probably going to come under even more pressure. The likes of Sasol will come under a lot of pressure. But I think there are also companies that are developing solutions around the carbon decarbonization. So we're likely to see that anything related to new electricity or renewable energy, I think is likely to benefit into the future.
As we wrap up, is there one risk that you're keeping an eye on for 2024?
Absolutely. I think the geopolitics is a major factor that we are worried about. If you look at what's happening in Europe, in Eastern Europe, the situation with between Russia and Ukraine, Ukraine supported by NATO members, I think that situation could escalate very quickly and turn into a disaster. You also have a situation in the Middle East where you could also have another disaster if, for example, Iran gets sucked into the Hamas-Israel war, or you also have the Turkey getting sucked into that whole environment. So that is the biggest risk to markets, I think. And what concerns us in particular about that is that the level of diplomacy has deteriorated over the last 10, 20 years. And we are seeing more aggression across countries.
Zwelakhe, thank you so much for your time. That is Zwelakhe Mnguni, who is the Chief Investment Officer at Benguela Global Fund Managers. And just to note, 17 of the 19 Fed policymakers indicating that they are seeing rates lower by the end of 2024. Remember that balance of risk was one of the key issues that Fed Chair did touch on about a couple of weeks ago. And he is saying that it is starting to come back into balance, so to speak, and focusing back on that dual mandate, which is, of course, of full employment as well as maintaining stable prices.